We're going to go to part 2 of our recording, gentle folks. We're looking at, in the previous clip, we're looking at expenses, not a legal expenses allowable and not allowable, right? Let's look at an example here. It says, in September 2013, a massive fire destroyed a large quantity of goods, and the building that housed the John Hung Market supermarket. A claim A claim was made to their insurers, and upon assessment of the damage and loss suffered, John Hung was awarded 15 million in insurance recoveries on December 21st, 2014. Legal fees in the amount of $120,000 were paid to acquire a new property to replace the fire damage one. During the year 2014, legal fees in the amount of $78,000 were paid to pursue the collection of outstanding debts, and it was agreed that the general provision for bad debts should be increased to $550,000 from $420,000. Here now, the treatment of the insurance recoveries and legal fees are as follows. Now, the insurance proceeds of 15 million received in December 2014 should be included as taxable income in the computation of the tax liability for a year of assessment 2014. The legal fees paid to acquire the new property are not an allowable deduction because it constitutes a capital expenditure. Remember this, because of acquiring a fixed asset or capital asset or an enduring advantage, that is what? Not allowable, right? However, the fees incurred in the collection of outstanding debts would be allowed. They are revenue expenditure incurred in the day-to-day operations of the business. General provisions for bad debts would not be allowed. Alright. Other allowable expenses now include, in the following sections, the other allowable expenses that will be looked at are advertising, business entertainment, insurance, donations to charities, and subscriptions to journals and magazines. Now, provide advertising now. So, provided advertising is for the business, it is an allowable expense, right? Normal recurring advertising expenditure is allowed, that is in newspapers and television, and cinemas. Also allowed is the cost of the distribution of free samples of goods dealt in and expenses of participating in a public or trade exhibition. No deduction is allowed for advertising outlay that represents the cost of construction of apparatus of a permanent or durable nature, such as an advertising billboard. All right. In ISA and Bros versus the Assessment Committee, Jamaica, an amount spent on advertising a hotel before it opened for business was allowed. All right. Then look at business entertainment now. A person carrying on a trade or business or profession may be allowed as a deduction. Expenditure on the entertainment of customers or clients, provided that the expenditure is wholly and exclusively incurred in what? Acquiring the income. It would be appropriate, however, for the commissioner to disallow the cost of the meal of the person, is a businessman or his staff member, who entertains the customer. So the businessman should not. That amount would be what? Disallowed, right? The benchmark case here is Bentley's Stokes versus Lawless and versus Beeson, in which a firm of solicitors incurred expenses in entertaining clients to business lunches. The CIR sought to disallow a proportion of the cost of entertaining on the grounds that the expenditure included the cost of solicitors' own meals, to say that the whole cost was allowable. If any of employees enjoy some of the hospitality which is arranged for the customers, the cost of employees' meals is what? Allowed. Under Section 13, the Commissioner may require that the businessman furnishes particulars of the entertainment and of the persons who were entertained as well. Now, this is tricky. Um, in this case, um, the meals, even if employees enjoy some of the hospitality which is arranged for the customers, the cost of the employees' meals is what? Allowed. Alright? Remember that one. Insurance premiums now and policies of indemnity in respect of the business, fire, burglary, employer's liability, marine or aircraft insurance, plate, glass, goods in transit, motor vehicle, and loss of profits are allowable deductions. Where stock has been destroyed by fire, hurricane, or other disasters, the full amount recovered under insurance policies is a, is a trading receipt and must be credited in computing the profits for income tax purposes. Townend and IT Assessment Committee versus IT Assessment Committee outlined below is an example of a taxpayer receiving insurance proceeds when his banana cultivation was wiped out by a hurricane and his claim that the receipt was a capital payment was unsuccessful. The division was that the full amount of the insurance money must be taken into account in computing the income without allowance or deduction or for any difference or supposed difference between the value of the insured property and the value recovered. That means that the money that was gotten from the insurance company, it should be added back to net profit to adjust the net profit. Alright? You can pause the video and read through the case if you so desire. Alright? And the document is uploaded somewhere, so you can download the document and read through the case if you so desire. Alright? Compensation received by an individual operating a business under an employer's liability policy is treated in the same way. In terms, in general terms, where the business is the beneficiary of a policy taken out against loss of profits consequent on the death or injury of an employee, the premiums are admissible deductions, and the sums recovered are trading receipts, provided that the sole proprietorship is employer or and employee. Sorry, the sole ownership is employer and employee. The insurance is intended to meet lost profits to meet loss of profits from the loss of the employee's services as distinct from loss of goodwill or the capital loss. If insurance is against death, it is a short-term policy providing only for a sum to be paid in the event of the insurer's death within a specified number of years. Otherwise, the premiums are usually not allowable except where the related policy is against the liability to pay compensation in the event of death or disablement of an employee. Subscriptions subscriptions that are wholly exclusively and necessarily incurred for business purposes are allowed. For example, subscriptions to the Chamber of Commerce, the Master Builders Association, or to a professional body such as the Jamaica Institution of Engineers or ICAJ, where membership is a precondition to practice. Donations. A new Charities Act came into effect on the 24th of December 2013 and introduced a legal framework for establishing a registered charitable organization. To obtain the status of registered charitable organization, charities must make an application to the regulatory authority. The Department of Cooperatives and Friendly Societies comply with the guidelines of a charitable purpose and provide details of the governance of the charity. The DCFS will make a decision and forward the application to the Commissioner, and if he has no objection, the charity is granted RCO status. The RCO will be included in the Register of Charitable Organizations maintained by Register of Companies. Only donations to RCOs are eligible for tax relief. Donations may not exceed 5% of statutory or chargeable income in the year of assessment. Alright. Then you have foreign exchange losses. The act is silent on the treatment of this expense. However, in practice, foreign exchange losses are allowable if the related transactions are of a revenue nature. Losses from transactions involving inventory, trade receivables, and payables can be allowed as deductions. Losses arising from the payment of interest may also be allowed. That is debited to the profit and loss account. Alright. You can read through if you please, but we don't read through if you so desire. Now we're going to go to this expenditures not allowable. As mentioned in 8.3, certain expenses have been expressly excluded by income tax as allowable deductions for income tax purposes. Section 15 sets out some of these expenses. Again, as mentioned in 8.3, certain expenses have been expressly excluded by the Income Tax Act as allowable expenses. That means that they are not allowable, right? As allowable deductions from income tax for income tax purposes. Here, they domestic or private expenses not allowable. Any capital withdrawn or any sum employed or intended to be employed as capital, any capital employed in improvements, any loss not connected with or arising out of the trade, profession, or vocation, rent of or cost of repairs to any premises or part of premises not paid or incurred for the purpose of what? Producing income. Now, as this is how we do it now. Alright. Earlier chapters, as stated in chapter 7, at year end, financial statements of a trade, which is our profession, will be what? Prepared using normal commercial accounting principles. But for taxation purposes, a statement must be prepared, adjusting the accounting profit to the what? Taxable profit. This procedure is necessary whether the taxpayer is a sole trader, a partner, or a limited liability company. Items in the accounting profit and loss statement which are likely to require adjustments are expenses of a capital nature, expenses not only and exclusively laid out for the purpose of the business, gains or losses of a capital nature, income received which was taxed at source, and appropriations of profit. The principles governing A and B above have been dealt with already. Alright? The amount of any such expense found in the profit and loss statement must be what? Added back to the profit or loss. Please note this into folks, as the case may be, thus increasing the what? Profit or reducing the loss. The charge for depreciation is also what? Added back, and the capital allowance deducted instead. Good. Items numbered C to E will be discussed as we go further at this moment. If I were you, I would pause the video and write this down. Thank you very much. This is how you're going to adjust the accounting profit. If you look at your course outline, you will see a case where you have to adjust profit for the sole trader. We are looking at that's the point we are going to at this time. All right, adjusted profit for the sole trader. All right, gains or losses of a capital nature now. We are in the course of trade or business, and as it is sold, a disposal account is prepared, which brings together the cost of the asset, the provision for depreciation to date, and the sales proceeds received. The balance on the account is the gain or loss on disposal, which is debited if it is a loss, or credited if it is a gain to the profit and loss account. This capital transaction must be adjusted for income tax purposes. Therefore, a gain on disposal is what? Deducted from the accounting profit, and a loss on disposal is what? Added to the accounting profit. Okay? In the capital allowance adjustments for tax liability, a balancing allowance or a balancing charge will be computed on the what? Disposal of an asset. These things might not be clear to you as it. When you do go through the calculations in a follow-up video clip, you will see the calculations and it will be more clear to you at that time. Alright? Income received which was taxed at source. When interest on a bank deposit or financial instrument is paid, tax is deducted at source. Businesses often have investments. They may hold debentures or repurchase agreements of deposits with financial institutions. Businesses which receive this interest or investment income in preparing the financial statements included included gross under the heading other income. Some income will be incurred in the financial accounts if earned but not received. For tax purposes, interest income is included in the taxable income when it is actually received. Interest income earned but not received is adjusted in the what? Tax adjusting statement. And where interest income has been received and been taxed at source, the tax is brought to account in the tax adjusting statement. Alright? Dividend income is taxed at source from March 1st for March 1st, 2013. This was increased from 5% to 15%. This tax is a final tax and is therefore not available for set off. It does not affect a tax computation in the business tax adjusting statement. Now we'll look at another section now. We call it appropriations of profit. Appropriations of profit are not allowed in computing profits for income tax. Appropriations of profit include drawings by, salary paid to, and goods taken for own use by the owner of the business. It also include sums paid to the owner's family and relatives, include interest paid or credited to the partner's capital accounts, the charge for income tax, transfers to general reserves. In normal accounting practice, after the profit figure has been found, an amount is allocated to charge to taxation, after which a profit after tax is produced. In the interest of prudence, a portion of the profit is usually transferred to the reserves. In partnership accounts, the partners receive interest on the capital contributed out of the profits. These items and drawings are appropriations of profits and as such are not allowable deductions for taxation purposes. Drawings of the sole proprietor from the time to time will draw some money from the business for himself, sometimes calling it salary. He also may not distinguish between his personal expenses and his business expenses, perhaps using the same bank account or credit card for both. For accounting and taxation purposes, all personal expenditure must be excluded from the accounts of the business. Whether the owner draws sums for himself on an ad hoc basis or chooses to pay himself a salary of a fixed sum every month, the amounts taken from the business for his own use are what? Drawings. Good? Straight up, right? As he owns the business, all, all the profits or gains belong to him. Therefore, his drawings are an allocation of his profits and are not allowable deductions. Alright? Where the business pays domestic expenses for the owner, such as utility bill, school fees, airfares, or anything that the owner, taxpayer, or his family benefits from, these are drawings and as such are an appropriation of profits. If these amounts have in error been deducted from the profit figure, they must be added back to arrive at the what? Taxable profit. In the case of goods taken for the owner's use, the value which must be debited to the joint account is the selling price of the goods. Alright? They have remuneration of relatives. It is a very common practice for sole proprietors and family owned businesses to employ members of the family in the business. These relatives should be paid a salary which will be taxed in the normal way. In order to prevent this from being used as a tax avoidance measure by including relatives who do not work in the business, the amount has to be commensurate with the duties performed and agreed with the commissioner. You can look through this example to see an area, idea of how this will be calculated. Alright? Let's look at the example though before we go any further. Now, says Mrs. Riley owns and runs a mini mart. She lives with her family in an apartment above the business premises. Mrs. Riley owns the building. At the year end December 2013, she had an accounting profit of 4.2 million. An examination of the amounts charged shows the following. Salaries include 320,000 for Kiri, Israeli's data. Included in the general expenses were figures amounts of 15,000 per week, which Mrs. Riley takes as her remuneration, and 5,500 per week, which paid to a domestic helper who gives one third of her time to the mini mart. She paid $48,000 for what for water and 150,000 for electricity. Estimated family use of these utilities is one third. Each week, groceries of $6,000 are taken from the business for family's use. The average markup on goods is 40%, and costs. Goods taken for the family's use have not been taken into account in the profit and loss account. The following adjustments are required. Now, this is a now this is Riley's salary, which is $780,000, because it's 5,500 per week. No, hold on. So so it's 15,000 per week. She takes as her salary, right? And if you multiply 15,000 by 52, you get 380,000 right here. So good. Domestic helper now is 5,500 per week, right? Now give you 200 to a domestic helper. Now, so she give you domestic helper five per week. Who gives what? One third of her time to the what? Mini mart. So therefore, If you multiply the 5,500 by 52, you get 286,000. But she must be only she must be only paid for only one third of that belongs to her, right? So it'd be 196,667 because this is the one third amount of the you'd have taken out one third of the total sum, right? The total sum would have been 5,500 times 52, which will give you which will give you 286,000. You're gonna find one third of that 286,000. You're gonna subtract that figure from the 286,000, and that will give you $190,667. Then she paid 48,000 for water and 150 for electricity. Estimated family use of these utilities is what? One third. So one third of this is for what? The family use. Good. So let's look at it now. So should have added in the full 48,000, but it should not be the case. It should be less. It should be one third less. So you're gonna find one third of 48, which is really 48,000 divided by 3. And give 6, so you get 16,000. That 16,000 should come out. Good. Electricity now, same thing, divide by 3. Goods taken, 6,000. We're taking from the business for family use. Average markup of what? 40%. Alright. Which would be, so it would be 6,000 times 1.4 times 52. Alright, which is per week. This is the amount of money that should be added back to the profit. Let's go now. The remuneration of 22,000 for the year of Mrs. Riley's daughter would be allowed, right? Provided the commissioner agreed that it was a commensurate with your duties. Mrs. Riley's salary is an appropriation of profit and is what? Disallowed. The domestic help expense for the year is what? 286,000, of which two-thirds benefited the what? Family, and is added back to the what? Shop's accounting profit. That two-thirds of 286,000 will give you the 196,667. Good. Water and electricity expenses of the mini mart are what? Two-thirds. Therefore, the family's use of one third is what? Added back. It is 16,000, right? Goods taken for the family's use are calculated at market value, and the amount added back, thereby increasing the what? Shop's profit. The adjusted profit for the tax purposes before capital allowances now is what? 5,643,467, because you have added back the 1.73 to the 4.2 million up top. Alright? Which is this 4.2 million. Hold. Shoot. Then you have a depreciation charge now uh, in the profit and loss statement. Now, a basic concept of accounting and depreciation and preparation of financial statements is the matching of the income earned with the expenses incurred in the earning the income. The long-term assets, such as buildings and vehicles, have also been used in earning the income for the period. The annual depreciation charge is an estimate of how much of the assets has been what, used up, and is debited as a charge in the profit and loss account. As a capital related charge, depreciation is not allowed as a deduction under Income Tax Act. However, certain allowances described as capital allowances, which we did before in previous lessons, are given for investment in certain assets and are set out by revenue. In the tax adjusting statement, therefore, the depreciation is added back to the what? Accounting profit figure, thereby increasing the taxable profit or decreasing the accounting loss. And the capital allowances are what? Deducted. Good. The steps in preparing the profit and adjustment statement are, and this now is for what? Sole proprietor, right? Please write this down for God's sake and remember it. The steps in preparing the profit and loss adjustment statement are analysis of expenses debited or items credited to the profit and loss account, preparation of the profit adjustment statement by starting the accounting profit as starting the accounting profit or loss as given. So you're going to start with the accounting profit or loss as given, add back what? Depreciation, add back any expenses what? Deduction not allowed, adding balance charges if any from capital allowances, then deducting profit or adding loss on disposal of fixed assets. And you have deducting what? Capital allowances, including what? Balancing allowance. Alright. The resulting figure, after you have done that now, is the adjusted profit for tax purposes. If a taxpayer has other sources of income, in addition to the trading profits such as interest from deposits, these would be added to our statutory income. The income and allowable deductions discussed in this chapter have been illustrated in the examples of sole traders who are taxed at 25% and adjustment and the adjusted profits after including any other sources of income and claiming the threshold and any other personal reliefs. The same theory and profit adjustments relating to expenses apply to all businesses. Corporate businesses do not, of course, have a tax exempt threshold, but they have additional provisions which I'll deal with in later chapters. Please do continue to read through. You can read through this for yourself as well if you want to. And please do have yourself a wonderful afternoon. These are some questions which you can go through for yourself for further understanding of what was discussed a while ago. God bless you. Keep you. His face is shine upon you. Please go back to the video. Go through these questions. Practice them as you wish. Thank you very much. Take care of yourselves. See you in the future at another time when we will continue do what we must. You can do these questions on your own as well. Then the folks, if you so desire, they are here to practice them. Practice, 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 practice. Enjoy your evening.